The U.S. economy will collapse completely and cease to be a superpower within a decade. Who will win control of Congress? The U.S. midterm elections are still underway. Global investors are also bracing for a split in the U.S. economy. Polls and betting markets suggest that Republicans are favored to win control of the House of Representatives and the Senate, while macroeconomic concerns and Federal Reserve monetary policy have been the dominant forces in market movements this year. Capitol Hill politics could have an impact on asset prices going forward. Data analyzed by RBC Capital Markets since 1932 shows that the average annual return of the SEEP 500 index has been 14 in a divided U.S. Congress and 13 in a Republican-controlled Congress under a Democratic president. This compares to 10 when the Democrats control the president and Congress. Troy Gajewski, chief market strategist at F's Investments, said a Republican Congress could end fiscal stimulus and make the Fed's job easier to break inflation. But some investors cautioned against expecting a repeat this time, given the uncertainty over the Fed's ability to rein in inflation at a faster pace and end the monetary tightening that has hit markets. Fed policy is still tight, and inflation is still too high, said James Aday, director of investments at Aberdeen. That's all bad news for the stock market. The U.S. Consumer Price Index has exceeded a 40-year high of 80 for 7 consecutive months, which is not a good indicator for Democratic seats. And the Fed's inflation target is still 2, suggesting that while the Fed may be turning, it is limited to or slowing rate hikes and does not mean rate cuts. As of now, pending the outcome of the U.S. midterm elections, the latest forecast from Chicagoland's FedWatch tool puts the probability of a 50 basis point hike at the Fed's December meeting at 56.8 and a 75 basis point hike at 43.2. Meanwhile, Tim Brisky, senior portfolio strategy in New York, said if the Republicans do get some power in the House and Senate, they could make raising the federal debt ceiling a very difficult process. However, with the U.S. equity options market relatively quiet, a surprisingly strong Democratic performance could upend the market. An analyst at Morgan Stanley said earlier this week that a strong performance by Republicans could ease investor concerns about increased fiscal spending and exacerbated inflation and increase the likelihood of a Republican spending freeze through the debt ceiling. They said this could support a rise in 10-year U.S. Treasuries and help extend recent gains in equities. I think the market is rising on gridlock, said Jack Ablin, chief investment officer at Crescent Capital in Chicago. Fiscal spending presents a challenge for global central banks. The prospect of no legislation is a bullish inflation signal. Meanwhile, multiple analyses suggest that a divided U.S. could lead to increased tensions over raising the federal debt ceiling in 2023, triggering a protracted boondoggle. This comes after international rating agency Standard & Poor's officially announced a few weeks ago that it had downgraded the U.S. credit rating for the first time since 2011, leaving the U.S. financial and debt markets in trouble. A growing number of investors are expecting a Republican victory in the U.S. midterm elections, an outcome that could temper potential Democratic spending and regulation, but could spark a bitter fight over raising the U.S. debt ceiling next year. At the end of October last year, the total U.S. federal debt hit the then $28.09 trillion debt ceiling. Since then, the U.S. Treasury has taken unconventional measures to avoid a debt default as a result. And in December last year, the U.S. Congress passed legislation to raise the debt ceiling to $31.04 trillion. However, as of 9 November, the total U.S. federal debt was already close to $31.03 trillion, just $100 billion short of the ceiling criteria. And depending on how fast the U.S. debt is growing, it could reach the ceiling level by the end of this month. At that point, if there is no new debt ceiling standard, it will mean that the U.S. faces the possibility of running out of funds for the national debt. Once the debt ceiling expires, the debt economy model of paying off the U.S. debt with new debt will come to a standstill. In the meantime, the White House could also stage a divisive spectacle of a shutdown. Analysts, quoted by the U.S. financial website Zero Hedge on 5 November, suggest that one would not be surprised if US Treasury Secretary Yellen joined others in privately requesting that Fed Chairman Powell slow down interest rate hikes. It is worth noting that U.S. Treasury Secretary Yellen has recently issued several warnings that the U.S. may run out of available funds and that the U.S. Treasury market may face a collapse. She also hinted that if the Republicans win control of Congress in the midterm elections, the U.S. debt ceiling may be frozen and they will use the next debt ceiling deadline as a bargaining chip for Biden to concede. This could trigger a default on us debt, which would be nothing short of catastrophic for the U.S. and for the growing divisiveness of the U.S. economy, which is also heavily indebted. Billionaire Jim Rogers, known as the most visionary Wall Street commodities king, has warned more than once that the U.S. is the world's largest debtor, that debt is everywhere, that sooner or later there will be a price to pay, and that the initiative for the sustainability of the U.S. debt economy model is in the hands of the few big global buyers. A new poll shows that half of Americans believe that the U.S. will cease to be a global superpower within a decade, and that there will be a total collapse of the U.S. economy. 10 years after the 2008 debt crisis, the U.S. has still not shaken off its dependence on borrowing, relying on the issuance of massive U.S. debt to drive its economy. Indeed, the U.S. economy and financial markets are now, for many investors, a real but hypocritical world of capital. In recent months, a growing number of big Wall Street institutions, economists, and entrepreneurs have been sending clear signals of an impending recession in the U.S. economy. Goldman Sachs has even warned that if US indebtedness is allowed to continue to climb, it will eventually jeopardize economic and financial stability. For too rapid a rise in interest rates would kill this debt. Full boom. This is the fundamental reason why US stocks, U.S. bonds, and other U.S. financial assets have been sold off so violently and continuously. So from this one perspective, what is the main threat to the U.S. economy? Is it overvalued US stocks, or is it a financial system that is in danger of another debt crisis rocking the boat? This is where hedge fund manager Paul Tudor Jones sees the biggest threat to the U.S. economy as the economic and social divide between rich and poor, with slow and uneven wage growth amid high inflation. Over the past 50 years, a very significant shift is taking place in the U.S. economy and society, with wealth increasingly concentrated in the hands of the group of people closest to the dollar printing press. They do not derive most of their income from their jobs, and, of course, they're the only ones who can take advantage of the official policies of the Federal Reserve. The gold standard is fair. It is the average American who controls the money supply, and it is now clear that U.S. monetary policy favors those elites closest to the money printing machine to the detriment of the middle class. This concern was expressed by Fed Chairman Powell in a media interview in September this year. He said that the U.S. population is aging, productivity growth will slow, and the chances of moving into the upper middle class are lower than in many other countries if you are born into a lower income bracket. He even said that these are issues that keep him awake at night, and that is one of the reasons behind his current desire to begin an aggressive contraction of monetary tightening to keep down hyperinflation. But it is now clear that the Federal Reserve, under pressure from the recession and the outbreak of the debt crisis, will probably once again concede defeat and surrender on monetary policy, and the consequences of this for the U.S. economy could be even greater. According to a report released by a U.S. survey agency, more than half of Americans believe that within a decade the U.S. will cease to be a global superpower and there will be a total economic collapse. Some 47% of Americans aged between 19 and 29 prefer other countries to the United States and have a significantly lower sense of belonging to that country. 36% believe that other countries are better than the United States. This is a recent trend amidst the continued high inflation experienced by the U.S. economy and the many uncertainties that the Fed's aggressive monetary policy has filled the U.S. economy with in recent years. Just click on these videos right here to know more about more secret news you didn't know about.